Welcome to the LuckScout Economic News. The U.S. economy, a complex ecosystem of interconnected forces, is sending mixed signals in 2024. Understanding these signals is crucial for investors seeking to navigate the current landscape. From the Federal Reserve's interest rate policies to persistent inflation, understanding these factors is paramount. Investors must carefully analyze these indicators to make informed decisions. The Federal Reserve's monetary policy, particularly its decisions on interest rates, has a profound impact on the U.S. economy. These decisions are not made lightly, as they influence a wide array of economic factors that affect everyday life for millions of Americans. Interest rate hikes, a primary tool to combat inflation, can slow down economic growth. When the Fed raises interest rates, it essentially makes borrowing more expensive. This is done to cool off an overheating economy and to keep inflation in check. They achieve this by making borrowing more expensive for businesses and consumers. For businesses, higher interest rates mean higher costs for loans, which can affect their ability to invest in new projects, expand operations, or hire new employees. Higher borrowing costs can dampen investment, leading to reduced business expansion and job creation. This can have a ripple effect throughout the economy, as businesses may cut back on spending, which in turn can affect suppliers and other related industries. Consumers also feel the pinch as mortgages, car loans, and credit card debt become more expensive. When interest rates rise, the cost of financing a home, buying a car, or carrying a balance on a credit card increases, which can strain household budgets. This can lead to decreased consumer spending, further slowing economic activity. When consumers cut back on spending, businesses see lower sales, which can lead to reduced profits and potentially even layoffs. However, the Fed walks a tightrope. It must balance the need to control inflation with the risk of slowing the economy too much. This delicate balancing act requires careful analysis and consideration of numerous economic indicators. Raising interest rates too aggressively risks tipping the economy into a recession. A recession can lead to widespread job losses, reduced income, and a general decline in economic activity, which can be difficult to recover from. Conversely, not doing enough to curb inflation can erode purchasing power. When inflation is high, the value of money decreases, meaning consumers can buy less with the same amount of money. This can lead to a decrease in the standard of living. This balancing act is closely watched by investors, as it significantly influences market sentiment and investment strategies. Investors look to the Fed's actions to gauge the future direction of the economy and to make informed decisions about where to allocate their resources. Understanding the Fed's approach to interest rates is crucial for investors. It provides insights into the direction of the economy and helps inform investment decisions in various asset classes, from stocks and bonds to real estate. By anticipating the Fed's moves, investors can better position themselves to take advantage of market opportunities or to protect their portfolios from potential risks. It provides insights into the direction of the economy and helps inform investment decisions in various asset classes, from stocks and bonds to real estate. By understanding the Fed's strategy, investors can make more informed choices, potentially leading to better financial outcomes. Inflation, the persistent increase in the general price level of goods and services, continues to be a major concern for the U.S. economy in 2024. This phenomenon affects nearly every aspect of daily life, from the cost of groceries and gasoline to the price of housing and healthcare. As prices rise, the purchasing power of the dollar diminishes, making it more challenging for consumers to maintain their standard of living. Eroding purchasing power and creating uncertainty for businesses and consumers, inflation is a key factor influencing investor decisions. When consumers have less disposable income, they tend to cut back on spending, which can lead to reduced revenues for businesses. This, in turn, can impact stock prices and overall market performance. Several factors contribute to the current inflationary pressures. One of the most significant is the ongoing disruption in global supply chains. These disruptions have led to shortages of key materials and products, driving up prices as demand outstrips supply. Supply chain disruptions, initially caused by the COVID-19 pandemic, persist in various forms. The pandemic exposed vulnerabilities in the global supply chain, leading to delays and increased costs. Even as the world recovers, these issues continue to affect the availability and pricing of goods. The conflict in Ukraine has further exacerbated these disruptions, particularly in energy and commodity markets. The geopolitical tensions have led to volatility in oil and gas prices, which ripple through the economy, affecting transportation, manufacturing, and even food production. For investors, inflation presents both challenges and opportunities. On one hand, rising prices can erode the value of investments, particularly those with fixed returns. On the other hand, certain asset classes may benefit from inflationary trends. Rising inflation erodes the value of fixed-income investments, such as bonds. As inflation increases, the real return on these investments decreases, making them less attractive to investors seeking to preserve their purchasing power. However, some asset classes, like commodities and real estate, often act as hedges against inflation. Commodities such as gold and oil tend to increase in value during inflationary periods, providing a buffer against rising prices. Real estate can also serve as a hedge, as property values and rental incomes often rise with inflation. Investors must carefully assess their portfolios and adjust their strategies to mitigate the risks and capitalize on potential opportunities presented by inflation. This may involve diversifying investments, increasing exposure to inflation-protected securities, or reallocating assets to sectors that historically perform well during inflationary periods. Understanding the underlying causes of inflation and its potential trajectory is crucial for investors. By analyzing economic indicators, such as consumer price index, CPI data, wage growth, and supply chain metrics, investors can gain insights into future inflation trends and make informed decisions. By staying informed and adapting their investment strategies, investors can navigate inflationary environments more effectively. Regularly reviewing financial news, consulting with financial advisors, and utilizing digital tools for real-time market analysis can help investors stay ahead of inflation and protect their portfolios. Trade wins: unpacking the U.S. trade deficit and its implications. The U.S. trade deficit, reflecting a gap between imports and exports, is another significant economic indicator. A persistent trade deficit can have implications for investors, influencing currency valuations and economic growth prospects. Several factors contribute to the U.S. trade deficit. The strength of the U.S. dollar, while making imports cheaper, can make American goods more expensive abroad. This can hinder U.S. exports and contribute to the trade imbalance. Investors closely monitor the trade deficit as it can impact various asset classes. For instance, a widening trade deficit can put downward pressure on the value of the U.S. dollar. This can impact the returns on foreign investments. Understanding the dynamics of the U.S. trade deficit and its drivers is essential for investors. This knowledge can inform investment decisions, particularly in sectors sensitive to international trade and currency fluctuations. Inventory insights: what shifting stockpiles signal for investors. Understanding the movement of stockpiles is crucial for investors looking to navigate the complex economic landscape. Changes in wholesale inventories, reflecting the level of goods held by businesses, provide valuable insights into the economy's health. These inventories are a key indicator of how well businesses are managing their supply chains and meeting consumer demand. These fluctuations can signal shifts in demand, potential bottlenecks in supply chains, and broader economic trends. For instance, a sudden increase in inventory might suggest that businesses are anticipating higher future demand, or it could indicate that current demand is weaker than expected. Rising inventory levels can indicate slowing demand, potentially leading to production cuts and job losses. When businesses find themselves with excess stock, they may need to slow down production, which can have a ripple effect on employment and economic growth. Conversely, declining inventories, especially if coupled with strong consumer demand, can signal economic growth. This scenario suggests that products are flying off the shelves faster than they can be restocked, indicating robust consumer spending and a healthy economy. However, it can also point to potential supply constraints and inflationary pressures. If businesses struggle to replenish their inventories, it could lead to shortages and drive up prices, contributing to inflation. Investors analyze inventory data to gauge the pulse of the economy and make informed investment decisions. By understanding inventory trends, they can predict which sectors might experience growth or contraction. For example, a buildup of inventories in certain sectors might signal a slowdown in that sector, leading investors to adjust their portfolios accordingly. This could mean shifting investments away from industries facing declining demand and towards those poised for growth. By closely monitoring inventory trends and understanding their implications, investors can gain a deeper understanding of economic dynamics. This knowledge allows them to anticipate market movements and make strategic decisions that align with their investment goals. This enables them to identify potential risks and opportunities, optimizing their investment strategies. In a constantly changing economic environment, staying informed about inventory levels and their broader implications can provide a significant advantage. Ultimately, the ability to interpret inventory data and its economic signals can be a powerful tool for investors. It helps them stay ahead of the curve, adapt to changing conditions, and make decisions that enhance their portfolio's performance. Whether it's adjusting to supply chain disruptions, anticipating consumer demand shifts, or navigating inflationary pressures, understanding inventory trends is essential. Investors who master this skill can better position themselves for long-term success. In conclusion, shifting stockpiles offer a wealth of information for investors. By paying close attention to these changes, they can gain valuable insights into the economy's direction and make more informed investment choices. So, the next time you hear about changes in inventory levels, remember that these shifts are more than just numbers. They are signals that can guide your investment strategy and help you achieve your financial goals. Please like the video and share it with others. Thank you for watching.